So these are some terms, and again, I would really encourage you to write in your own words these definitions. Get a sense of what they mean to you. I go through some additional explanation just to help cement it, but these need to also be sort of note card ideas that you can just instantly know what I'm talking about when I use these terms in my lectures. Sometimes I don't even know I'm doing it, and sometimes I won't necessarily go into the depths of description and describing it every time I use one of these. And that needs to be how common these things are to you. Book value is something I say all the time. I'm not going to read all of my verbiage, but it's just what is the value that an item is listed at on the financial statements. So if I look at the balance sheet, what is the number that is reported for accounts receivable? What is the number that is recorded for property, plant, and equipment? That is the book value of an asset. Remember that we talked about the measurement principle and a mixed attribute system. So the book value will be a product of whatever measurement principle we're using. Are we using fair value? Well, fair value is the book value of certain assets. Are we using historical cost? Well, then historical cost minus any accumulated depreciation is the book value for PP&E. And then I just roll through a bunch of examples of that. Net realizable value is a term that we use mostly in inventory and accounts receivable. And it tends to refer to, it's a shorthand way of saying expected exit value, which we've already covered. And you can go back and look at again. It's under the measurement principle. So net realizable value is just another type of book value. Or I should say, not another type because that sounds like they're distinct, but a subset of book value. And what I mean by that is, well, the book value of accounts receivable in inventory is called net realizable value, right? Fair market value is another, this is the current exit value that is prescribed in the measurement principle. And it is, again, a subset of book value. That is to say, some assets are recorded at fair market value, which is the value that we put on the financial statements as the book value. A little bit larger of a term that is bannered about a bit in the accounting financial reporting world is recognition versus disclosure. You got to understand what the distinction is because they're not interchangeable. Recognition, well, they're not. I mean, some people when they're sort of playing fast and loose with their language might interchange them, but we need to be careful and say the appropriate word at the appropriate time because they really mean, in a strict sense, two different things. Recognition occurs when an accounting standard requires that information changes the manner in which it is listed on any financial statement. So it could be qualitative. That means that we're not talking about numbers. We're talking about words used or the spatial orientation. So, for example, we need to recognize operating expenses and operating items and income separately from non-operating items. We may need to recognize receivables in different ways. For example, receivables actually come in two flavors. They come in trade receivables, and then they also come in non-trade receivables. So a company, if it has a material amount, and now again we're referring to a word we've learned. Remember, material means if it would make a difference in my decision making as an investor, then we need to have two line items for our receivables. Trade receivables are customer-based accounts. If you think about what we're saying here, it's we're trading goods and services for the entitlement to receive money in the future. These are the ones that you analyzed mostly in financial principles. Here, non-trade receivables, we're talking about non-customer base. So maybe it's receivables from subsidiaries that are not wholly consolidated, receivables from other entities that are not our customers. So we might have loaned some money to another company. We might be due a tax refund from the government. That would be another entity. Or even from our employees. Maybe an employee took an advance for some travel or on their paycheck. Then we have a future receivable from our employee. Others may entail a quantitative issue, so that would be altering the numbers themselves rather than just how we disclose things. So, the qualitative was, well, we can't report all of these receivables as just one item on a balance sheet if there exists a significant amount of non-trade receivables that would be material. Then we have to have 2 line items on the balance sheet. Because if you're an investor, consider which one of these types of receivables speaks more to the company's ongoing central operations, the company's ability to continuously generate profit. Well, in my opinion, you would want more trade receivables. So if there's a huge amount of receivables, but a huge amount of those receivables are from non-trade items, then that isn't necessarily as good as news as it would be if we had a recurring customer that was coming back to us time and again. Okay. So that is recognition. It's a stricter standard in terms of how we need to report, the influence it'll have on investors, the importance of the information. Disclosures occur when a standard requires the information need only be presented in the footnotes to the financial statements. So all we have to do is disclose what is going on these major items on the financial statements. Now, if you think about it, it's sort of an information overload to look at the entire annual report. It's, like I said, anywhere from 70 to 100 pages. If you're really wanting to save time, you're going to hit right to the financial statements, those 4 or 5 pages that are contained within that huge volume, because it summarizes everything in a great way. Well, you're only going to dig into disclosures if you start reading the other 65 to 95 pages of that report. So sometimes disclosures, they're not as prominently presented. They're not paid attention to by the general investing public as much. So it's a way of not hiding the information, but not being as sort of putting the highlights on it, underlining it, bolding it for everyone to see. And then I just kind of go into that down here with that verbiage. So I want to jump into now accrual versus cash basis accounting. If you've attended class, you've seen me talk about this, and it'll be a lot of the same thing. So it doesn't hurt to know, because I find that, or it doesn't hurt to hear it again, because not only do I find that repeated explanations are necessary to really ground ourselves in a topic. We think we got something after we've seen it once. Tends to be that we don't. There's still some loose ends. And also because this is just one of the most fundamentally misunderstood parts of accounting. When we defined revenues and expenses in those elements, we did not refer to inflows or outflows of cash, right? We referred to inflows and outflows of assets. We referred to incurrences or settlements of liabilities. So this was not cash specific. We were more general, and we were more general for a reason. Because under an accrual system, which is used by GAAP, cash-based system is not allowed under GAAP. We do not have to have cash exchange hands in order for us to record a revenue or expense or recognize a liability or an asset. We can recognize a lot of revenues and expenses in periods other than those in which cash was exchanged. So a lot of the time, we're not going to have this temporal alignment. At the point of time that I receive cash, am I going to record a revenue? Rather, I might receive cash and then record a revenue in the future. Or I might record a revenue in anticipation of receiving cash in the future. You can think about some of those examples, and I go over them in my slideshow and in class. So under the accrual basis, we're no longer using cash. Therefore, in order to determine on a consistent and logical basis when we want to recognize revenues and expenses, we have to appeal to different criteria. We're going to appeal to the realization and the matching principle. This is why I harp on those so much. Not only are the realization and the matching principle telling us when we're going to recognize items that influence net income, and net income is so dang important in the financial reporting world, but also they are tied into what forms the accrual basis of accounting. One thing I also want to draw your attention to, because cash does not always coincide with the use of assets or the settlement or origination of liabilities, accrual accounting provides a superior view of future performance. And that is so important when we are hoping to help investors and creditors with their investing decisions. We want our information not only to tell the story of what happened during a period, but to be useful in future predictions and the mapping out what the future of the company might look like, to extrapolate beyond the present time. Accrual accounting better predicts future accrual income, net income. So a couple things to consider here. Net income is an accrual-based number. Income is made up of revenues, expenses, gains and losses that occur during the period. Some of those revenues, expenses, gains, and losses under US GAAP will be recognized based on the realization or matching principle, based on an accrual system. Therefore, the result of combining all those numbers, net income, is an accrual-based number. So what this first one is saying is that net income in the present is better at predicting net income in the future than cash in the present is at predicting net income in the future. And that, you might say, well, yeah, that makes sense, right? Of course, something of net income would predict future net income better, and you wouldn't be wrong. However, the most interesting thing to me is that net income in the present is better at predicting future cash. So having net income in the present allows us to better predict what future cash flow is going to look like, better than present day cash flow. And that's really the mark of the superiority of this system, and that's why it is required by US GAAP. This was partly was researched and shown to be empirically true with data from companies and future data from those companies. So it was a really interesting research article. So then we look at strict and modified cash basis accounting. So the strict basis is not allowed under GAAP. And it's kind of, it's exceedingly simplistic. And I couldn't even imagine using it for much more than, you're the treasurer of your student organization or some, church organization, and you just want to give people the sources and the uses of cash. You're not worried about the profits you're generating. You're not obtaining substantial assets and deploying assets. It's simplistic and problematic because basically the rule of the strict basis is you recognize revenues when cash is received, you recognize expenses when cash is spent, right? It's not used by companies that have loans. It's not used by companies or that have any inventory, that have anything substantial going on. Like I said, very small organizations. Like I usually joke, your child's lemonade stand could use a strict basis system, but other than that, it's really pretty useless. Now, there is a modified basis that's allowable under GAAP for smaller companies. I think that the net assets have to be under 5 million. The net assets of the company have to be less than 5 million. And that doesn't sound very small to us, but when you consider that the net assets of most of the companies are in the hundreds, if not billions of dollars, then yes, we're talking about pretty small fries. And also, the company can't have any inventory. It cannot have any inventory. So what we're talking about more is a service-based company. This would be useful perhaps if you have a law firm, a CPA firm. You don't have inventory in those companies, and it might be a smaller public accounting firm, or it might be a small tax consultation firm. You could use a modified cash basis. What's the difference? Well, it's basically a modified cash basis and an accrual basis stuck together. You practice accrual basis accounting for long-term items, any fixed assets that the company owns, like furnishings, computers, I don't know what else. I'm fumbling. Equipment, and then any rate. So if you borrow money, if you take out a loan, those things would be recorded as they are under an accrual system. And then cash basis is used on a short-term items like accounts receivable, accounts payables. Those are just cash basis accounting. We don't worry about having cash and revenues, expenses deviate when it is a short-term item. I'm going to look quickly. Actually, you can roll through these on your own, and I don't think we need to air time with it. I encourage you to. It just shows you the big difference between accrual accounting and cash accounting. Like when we purchase machinery under strict cash, it's no longer equipment that gets debited and cash that gets credited. We credit cash still because cash went out the building. That doesn't change. But we no longer get to record an asset. It just becomes equipment expense. And so we don't get to show anyone who's viewing our report that, wait, I have equipment now. All I see is an expense. So that sort of stuff, it becomes really impossible to use strict cash. And then I just have a little bit more complicated example that would be worth looking through, especially when you're shoring up your memory about basic transactions. In this transaction, we're receiving cash ahead of time for a service that we're going to discharge in the future. Okay. So I'm going to end the video there, and then we'll look at one more that involves the accounting equation.